Well, thank you really to the Ron and the panelists on the first go-around, because I think it set a nice framework for thinking perhaps mechanically in terms of the instrumentation on one level, and it's a good opportunity to get coffee, but unfortunately in the interest of time, I think we'll go ahead and proceed. Assembled really a distinguished panel here in the second panel that ranges both from a lot of the different legacies and interests and development of ideas both in the financial sector, in the public sector, and in the private sector, including our representative from the Netherlands, who's now actually in D.C., who's also carrying forward Dusan's ambitions for domesticating some best practices, or at least thinking in unconventional terms about the instrumentation, the associated risks, and the associated returns going forward for how we finance resiliency. So with that, I've asked each of the panelists here to, with a bit of a primer, to take on a certain topic for a few minutes to give us a reference point for the balance of this panel. We'll proceed with some questions and then most importantly open it up to the audience, because I think some of the highlights, rather some of the questions that were highlighted in the previous panel specific to tax credits, I think are going to be, and a number of other mechanisms, let's say value capture, equity within this realm, I think are going to be very important topics for this panel to take on with some level of resolution. So we will skip the introductions, as you can all read in the pamphlet, really a quite distinguished panel. And I'll start here with Chuck Laven. And Chuck, and I've asked you, we talk briefly in anticipation of this panel and thinking about, as we all know, with the National Flood Insurance program, the necessity to elevate certain structures given the relative financial consequences of increased premiums. And we started talking about a second mortgage program, or a mechanism by which one at the consumer level could finance these. And very quickly, this proposition of negative equity came up. So perhaps you could lead us off with your perspective from a macro view in terms of what are the opportunities for community-based funding, or for consumers rather, either one, in terms of promoting resiliency. What is a reasonable ambition that we hope to accomplish, either through policy or through private market interventions, which could possibly leverage public capital? So I know that's a bit of a vague, ambitious question in and of itself, but I think laying the groundwork for what you see as being a reasonable ambition, I think will ground the panel going forward.
So without being too grumpy or negative, I think the short answer is none. But let me try and back up from that. At first blush, the problem is, I'll try to speak to the problem as a municipal finance problem, sort of my area of expertise, how to structure municipal bonds, how to capture value to structure municipal bonds. And financing resiliency, financing adaptation is a cost at a very local level and a benefit at a very broad level. That would typically be done with general obligation bonds across a very broad taxing district. We all benefit, everybody pays. So we need to do GO bonds. That is politically difficult in this environment. Where it's very individual level expense and individual benefit, we would typically do revenue bonds. I'm talking now solely about the tax-exempt bond market. I generally view this as a municipal finance problem, not a private finance problem. It's probably a federal municipal finance problem or a state municipal finance problem, not a local municipal finance problem. You'll see I'm digging myself into a hole of political impossibility here. But I think the reality of the nature of the finance problem, you ask the typical finance questions, who pays, who benefits, who's at risk, who's at blame, and you come to this is a collective problem that requires a collective form of taxation. That's a GO bond. So what can be done at the very project level? Try to be a little bit more practical, because what I've just described is a political conundrum that in the short run is not going to be solved. It strikes me we have to stratify projects by density, time horizon and certainty of projection of benefit. High-density projects will be easier to finance than low-density projects. Projects with short-term time horizons of benefits will be much easier than long-term time horizons of benefits. Projects with certainty of projection will be much easier to finance than projects of uncertainty of benefit. Financing against uncertain future insurance costs will be very hard. Right? We don't know 5 years from now what the insurance industry is going to price as a set of risks. Financing against that savings today is almost very, very difficult. A few more problems. Financing against small properties and small businesses has typically been a very hard financing problem in the municipal sector. Financing against larger properties and larger businesses, much, much easier. All that being said, this essentially argues for stratifying projects very, very carefully by their density, by their location. It argues for a political problem, which is trying to do this with general obligation bonds rather than revenue bonds. There are a few things that are critical that can make this work, and then I'll stop. In the past, we've worked on a variety of infrastructure financing districts, TIF districts, worked on the financing of the Stapleton Airport in Denver, essentially a blank slate of asphalt that a new community was built upon with municipal bonds financing against future growth. What's needed at the governmental level in order to make community level financing is guarantees of some kind or another. Guarantees against timing mismatches. The benefits don't come on time, and therefore the bonds can't be paid. Guarantees against failure of projections. There's massive uncertainty as to the value that's going to be created by the mitigation and measures, so you need some kind of balance, some mechanism to finance against the failure of the projections. And finally, financing against huge amounts of uncertainty. Insurance cost, I think, is the big one. Projects will live or die in the future based on what the catastrophic reinsurance industry figures out is the appropriate pricing. Catastrophic reinsurance industry is muddling its way through. So far, most of the things I've seen written say, yes, it's a big problem, we have to change our models. But that means 3, 4, 5, 7 years hence, we're going to see a very different insurance structure than we see today. That's a huge uncertainty that makes it very difficult to finance at the project level. So on those depressing notes, I'll stop and look forward to reacting after everyone else has had a chance to talk.
No, I think it's not a matter of being depressing as it is being realistic. But I think what we spoke of in the first panel is a matter of judgment. It's about a matter of informing judgment. That's a judgment about financial risk, about returns, about the probability, qualitative, quantitative, whether in terms of the implications of what these types of investments are. And Marcel, we'll come back to you on the public guarantee, but I wanted to skip over to Richard Roberts here. And given your public service and your legacy in New York, and really we spoke of in the previous panel about the interstitial development plan and a number of implications for NYCHA and public housing, what do you see the priorities for the monies allocated to NYCHA for upgrading, and to what extent can we have some mainstreaming of benefits? That is, benefits that accomplish, that is the allocation of funds that accomplish multiple benefits, whether it's the physical integration or upgrading of building systems or other public spaces or social services that fall within that realm. Where do you see these priorities going forward?
Well, I think, thanks, Jesse. You know, it's interesting, and just kind of thinking about Chuck's comments, you know, the issues that get presented by these catastrophic occurrences are sometimes not that much different than what's going on in the general market. I think if one were to ask people about financing and the prospects of things that would actually be more attractive to investors and folks who finance these types of activities, I think, you know, certainty would be preferable to uncertainty. So whether you had a catastrophic event or didn't have a catastrophic event, you know, you'd be looking at things like higher density and things of that nature that would create greater returns. And just to follow up before I forget them, because I'm now at an age where actually, unless I make the point, I forget the point. But you know, one of the other things that's going on that Chuck didn't mention is that there's a tremendous amount of consolidation going on in the insurance market with insurance companies, and that's creating another wave of uncertainty out there in the in the background. But to address Jesse's question, NYCHA, I guess there were something like 400 buildings that were damaged in the aftermath of Superstorm Sandy, and I think the priorities seem to be on replacement first and rebuilding with resiliency in mind. And as you suggest, it's always a question of money. And I think that as far as trying to understand how these issues, I think, will ultimately affect NYCHA, I think we have to step back and think a little bit about where the housing authority is, in New York City, where public housing is. We're now, I guess, 80 years into the experiment of public housing in New York City, and after enjoying a golden age of sorts prior to the hurricane, public housing in New York City was experiencing an enormous challenge of identifying both sufficient financial resources on the capital and operating side of the equation. And that was in large part as Washington in particular, and I think that while it's very comfortable here in New York City to trust the tabloids' view of just about everything and believe that most, if not all, of the problems with public housing in New York City have been generated and created here in New York, that is in fact not the case. Since the early 1980s, the federal government has basically decided to remove itself from the business of supporting public housing, less and less support over a period of time, having kind of a tremendous and dramatic impact on the quality and the ability of local housing authorities to operate. And that is in large part a function of initially the executive branch's attitude starting in the Reagan administration, and has been continued and picked up with a great degree of vigor by the Congress, the current Congress. And I think that makes it harder and harder for local housing authorities to operate, and that is in the context of all owners of rental housing, both market rate and affordable, having a difficult time making ends meet. And so when now confronted with additional issues of resiliency and dealing with catastrophic occurrences, it becomes much more difficult to operate, because even in a perfect world, it is difficult to operate. I think some credit has to be given to the Bloomberg administration with putting in place some creative financing techniques in a non-disaster recovery context, some of which has moved forward successfully, including significant allocations of, and folks alluded to it in the Q&A in the last panel, significant allocations of tax credit resources into public housing, which I think was a very unique and a very innovative strategy. And then some strategies which haven't moved forward very successfully, including the idea of doing long-term land leases for market rate development on high-value properties, which I think is probably something that's not going to be that's going to be accepted by the incoming administration. For the most part, I think the projections indicate that NYCHA's resiliency and rebuilding efforts will be covered in the money that's being allocated in either the CDBG grants or other types of money that's out there. But given the severity of NYCHA's budget challenges as a general matter, one must wonder whether additional resources are needed to not only continue to operate the housing authority, these units effectively, but to deal with what happens if another catastrophic event were to occur. And frankly, disaster recovery is becoming a game of musical chairs. As the number of incidents increase, particularly in Washington, the public urgency for full and committed funding of recovery costs seems to be lessening and lessening. It takes longer to get money approved. You think about the relative ease in which and bipartisan support that came in the wake of Katrina and the difficulty that occurred post-Sandy. I think people are becoming much more self-interested and inwardly focused as they look at their, as they look at these events. That's not our event. That's New York's event. And I think it's becoming increasingly difficult to advocate for funding and the type of full funding that would be necessary to support rebuilding efforts when these events occur. I, for one, would be an advocate of an expanded exploration of privatization of public housing authority assets, including storm-affected areas. The transfer of ownership in the main from the housing authority to privately held limited partnerships, either those controlled by community-based not-for-profits or responsible for-profits, with NYCHA participating in the ongoing management and operation of those units, with the proviso that those partnerships be required to preserve the affordability of the housing in perpetuity. We don't want a repeat of the Mitchell-Lama program. I don't know how many of you all are familiar with that, where there's in exchange for opting out of the tax benefits that the developers originally garnered, they're able to opt out now and to take that housing to market. I think that's a bad idea, and that's certainly not anything that I would be encouraging. But the shift of responsibility would allow proactive private owners, both not-for-profit and for-profit, to be focused in a proactive way on resiliency and operations in a way that I think would be very useful. And it often generates a significant infusion of capital into these critical public assets. So low-income housing tax credit, new markets tax credits, recovery tax credits, renewable energy credits, private activity, tax-exempt bonds. I agreed with the speaker from the prior panel that there are a number of fixes that need to occur if private activity bonds are going to be allocated in this fix. Many of the Liberty bonds that were utilized to rebuild Lower Manhattan in the wake of 9/11 were basically used to build luxury housing. Not that there's anything wrong with luxury housing. It's just I don't think that was the intention when those resources were allocated. Identifying effective ways to generate capital can help create effective delivery systems. The expenditures are often more palatable than direct support from either from the federal coffers or from the capital budget. That being said, there's no replacement. There's nothing as effective as cash. If we could have an argument all day long about whether Section 8 subsidies actually did more to benefit people than the low-income housing tax credit, but I don't think we're in a political environment where we're going to be able to give people cash. So with that, I'll close.
Thank you, Richard. That's really fantastic. I was a little surprised and excited, actually, to hear your proposition in terms of the privatization of the interstitial development opportunities. It makes one think of the history in terms of, here in the context of legal history, of the limited dividend corporation, which was quite active really in the 30s and the 40s, and I'm not really sure the ultimate history of that. But it does bring up some language, too, that's worth defining. In the previous panel, we talked about the triple bottom line, but in many ways, the scholarship has advanced, if only rhetorically, to the quadruple bottom line, which is the idea that, yes, you could serve the environmental sustainability, the social equity, the economic prosperity, but all within the confines of a fiscally an economically viable business model that I think enforces some level of discipline. That's my own imposition as an interpretation of the scholarship, but also provides a platform for engaging and leveraging really the totality of private capital markets. And I think that's a very exciting opportunity to really develop. And in many ways, if we talk about the legal instrumentation, perhaps there are mechanisms within existing corporate law that help define what these public-private partnerships in the truest sense and in a corporate sense really mean. Also, in the beginning of your discussion, picking up on Chuck's point specific to the insurance market, just recently I hosted a panel with Swiss Re and Lloyd's of London for the Rebuild by Design competition, and if they have now really taking, I think, a lead not only from their own actuarial undertakings, but also from the investment point of view, which is the principal driver, not the premium component of the insurance market. It's actually in the investment side, to really thinking about how they can get into this market on the investment side. There's also new products, for instance, the parametric insurance, which is fundamentally empirically based on the amount of, we talk many times in the world of urbanism about big data, and there was actually a New Yorker article recently on Climate Corporation, which is now lending itself vast amounts of information in the terabyte range to underwriting the economic performance of rural agricultural land and what that means to the pricing of that land as a multiple of the productivity of its use. And I think in many ways that is the type of totality of information. And again, it's a slippery slope, as you can imagine, as it always is with big data, but I think that level of resolution in terms of empirical resolution will advance notions of expanding insurance products, which can be diversified to address both public and private needs. But that's a whole nother topic. I want to turn over to James here and reaching into your expertise from a fiscal point of view, and as Chuck highlighted, many of these programs are dependent on ultimately on a public guarantee, and whether it's social impact bonds, social innovation funds. Where are we in terms of the fiscal state of the city, just the city, in terms of advancing the city's investment in some of these programs to leverage these types of investments? Are we in a position going forward to make these types of events, and how dependent truly are we on bringing in this private capital as an exclusive means to develop some of these programs?
I guess I come down on the side that while we shouldn't exclude or preclude thinking about ways in which there can be public guarantees to incentivize private investment. I've just finished a stint on the Tax Reform and Fairness Commission at the state level, and not so much in terms of incentives regarding financing, but we did look carefully at the broader question of business tax incentives as a way to incentivize investment and retention of companies in New York, and the conclusion from that was that it's a slippery slope. The temptation has been great for elected officials to project the appearance that they're responding to economic needs by passing a tax credit of this or that sort, with the expectation and certainly with the trying to project the public perception that they're doing something about a problem. And when you evaluate the effectiveness of those programs, and there's been a serious under-evaluation of a lot of those programs, but the state has put a lot of money into that area, and I think has very little to show for it. So I guess I come down more on the side that the government has access through its tax-exempt status to pretty low-cost financing, and we've certainly seen the low interest rate environment to support that in recent years. And I think that the long-term prospect for the New York city regional economy is so strong that I think we have a very expansive economic base and property tax base to support financing, so that if it's done well, that the public sector can do a lot of that. I guess I would want to draw attention to a particular type of public financing that was used in the Hudson Yards case. Not in a climate impacted area yet, but in order to promote development in that area. And there's a lot of misunderstanding about this because it's often described as an example of TIF financing, where the city set up a Hudson Yards Infrastructure Corporation to borrow money in order to pay for the expansion of the number 7 line from 8th Avenue over to 11th Avenue and down from 42nd Street to 34th Street. And that was going to be paid back with pilot payments in lieu of taxes and other development district related revenues. Now, why is that not tax increment financing? Because while it is paid for, the bonds are being serviced with tax revenues generated in that area, rather than a tax increment, there's actually a tax decrement principle at work, because those pilot payments were premised on the provision of tax breaks that were structured in a way to incentivize development near the access to mass transit and to encourage development to go in that direction. But that was a case where we were making a significant public infrastructure investment, and we were minimizing or lessening the prospective tax revenues that the city stood to receive from that. And ultimately, that's a way to finance less rather than more infrastructure investment. So hopefully we won't follow that model any further. And I think this is clearly a moment when we need to think about how to move the city more forthrightly away from a development approach that has been premised on tax breaks, not just in Hudson Yards area, but in other areas where we think that because land prices are what they are in New York, that we need to subsidize development and lower the cost, and the way government can do that is by affecting the level of taxation on that. I think we should recognize that high land values reflect a dense development that generates great potential for economic productivity, and that's the way it should be. And we don't need to lessen that cost, but we need to capture the value that further investment reflects, so that going forward we'll have more tax resources and greater geo-bonding authority if we just protect and treat our property tax base as a resource to be cultivated to pay for the infrastructure and other services that the city requires. So I think we need to get that right. There are other things we could talk about in terms of the property tax system itself, but I think the city has been for too long oriented toward an inclination that we need to provide property tax breaks to incentivize development in an era when we face resiliency problems. We certainly can't afford to do that, and we need to rapidly move away from that.
Thanks, James. We're going to take it, and I'd like to have this next question go to Wallace, and really take the proposition and the scale from the district down to either at the, let's say, one of transactional continuity and one at the consumer or building scale. So within, I believe it's Chapter 9 of the SIRR report, the financing component of it, they talked about numerous mechanisms, land mitigation for wetlands, a handful of sort of novel propositions. But one thing that they talked about was actually a specific surcharge or a specific tax to building owners and that were proximate to the area, which would necessitate a certain type of intervention, more specifically flood proofing. or flood protection, rather. And at the same level, so that's one level. It's a very simple concept of excising and exaction, and it's basically a tax. And on another level, there's, particularly within the domain of international best practices and scholarships, as it's known, they have been talks of taxing, essentially, entities which, in terms of climate mitigation, may be, advancing climate change at their own expense in terms of not internalizing the negative externalities, imposing something like a Robin Hood tax on them. And I'm curious from your perspective at either of those scales, either at the individual scale, the property owner scale, or at the scale, let's say, a market, what if these propositions are reasonable, or if it's just more pie in the sky tax.
Thank you, Jesse, and thanks for having me here. I just want to preface this by saying in the last few months I've taken on the great honor and the burden of studying what's happening in the city of Detroit and their bankruptcy. And from here I'm on my way to Detroit to launch a paper that I just did. Why is that significant? That's significant because in this particular circumstance, some of the issues about tax increment financing and the kind of tax breaks that are intended to spur economic activity within a city have become highlighted because they're out of money now, and the question is, what have they done to themselves and how will all that be resolved? And there's a very big move, for instance, to reclaim the tax benefits that were granted to a number of developers inside the city of Detroit right now. What that's all about is about how we think of ourselves as a society. We've become far more transactional. The whole idea of socializing costs, unfortunately, starts with the word socializing. And from a political standpoint, we have evolved or devolved into a situation where a lot of these issues become, they actually drive what we actually do, and we aren't very well equipped to measure social benefits and social costs. Private benefits and private costs are easier to measure. They're more obvious, and we like to measure things now. I'm going to get to it. I want to refer to 3 P's that I've heard mentioned here. The P's are political environment, palatable, and privatization. This is all about politics. If you talk about how do you finance something, meaning how do you raise cash now and pay for it later, it's all about identifying streams of payment that are reasonably reliable. And from a finance standpoint, something I did for a lot of years, it actually doesn't matter much how you raise where the cash comes from. From a strictly finance standpoint, it can be completely disconnected. But if we're not going to socialize the costs, although the Chapter 19 basically talks about socializing the cost of these projects, you get into the realm of how do you sell it politically. This is really palatability is about politics, and I don't think that we are in a place right now where we can socialize these costs terribly effectively. Privatization, let me say this, I'm biased about privatization. I had the position when I was at Goldman Sachs in London for a number of years in the early 90s, and I was on the Treasury Committee on privatization of infrastructure and public-private partnerships. And what I learned from that is that none of it makes much sense. And I said that, and I got to say, they were absolutely shocked in London that somebody from Goldman Sachs actually could express a progressive view. I spoil many cocktail parties doing that. Look, the question of nexus, you're talking about developing a nexus from a political standpoint. And there's 2 ways to do that. One, make a logical connection to the outcome that you're trying to achieve. And somehow that we find that gratifying. that you say there's a connection. The people benefited and the people who have to pay. I think in this case the people benefited are the entire United States, and the city argues for that because they argue that the economic benefit to the entire society of Lower Manhattan is something that's very important. I think that's logical, and I think it does benefit the entire society. Nonetheless, the urge to connect up beneficiaries and those who have to pay the cost is manifest in something that they've referred to as a resiliency assurance charge that's been suggested and has precedent in other states. And that really is to take property and casualty insurance and impose a fee on it to create a revenue stream against which you can borrow. It's in the state of New York historically, since the time of Robert Moses, has been the world's leader in that. Typically, it's been for political purposes to hide decision-making and to obfuscate who's paying for what. In this case, it's perhaps even more motivated by political reality. It seems to me that that is a perfectly viable way to go forward to demonstrate a cash flow stream that you can finance against. I think we have to recognize that it may be more complicated than that. These particular projects, if you look at the whole range of them, one of the things that's going to be a part of the process is decide. And it's, again, it's an issue of public abilities. Is how much of it can actually be done tax exempt. That's all about not about how you borrow for the money. It's about how you use the money, and that's something concerning. The other way to do it, if you don't have a nexus, you find something totally evil. And for instance, you tax liquor and cigarettes and pay for schools. People seem to like that. The newest entrant to the evil group is financial transactions. And so I've been heavily involved in something called the Robin Hood tax. I was in Washington a couple of weeks ago expecting to give a technical talk, and I found myself talking in front of about 300 people, each with Robin Hood hats on. So I went into my pep rally mode. It's a good talk, actually. Maybe I should do that more often. The Robin Hood tax puts a small tax on financial transactions, something that's been done historically many times. The politics of that are all about the financial institutions saying, be careful, you're going to kill the goose that laid the golden egg. Problem is the egg doesn't look so golden anymore. And one of the interesting things that's happening in terms of public opinion is that while we become more transactional, and that has its own inertia, people are actually angrier at the banks now than they were in 2008, 2009, 2010. So proposals have been made to do that. If you look at the revenue generating capacity of such a thing, I look at it from a different direction. I'm more interested in what will it do to the markets, particularly to high frequency trading. But if you look at the revenue generating capacity, it's been estimated on a federal level at $350 billion a year. And let's face it, most of that money is going to come out of New York City in terms of what's going on here. So another legitimate thing is to do that. I considered even the possibility of the city piggybacking on top of a Robin Hood tax were it to be enacted. I think trying to speak to get a share of that money is something that's actually pretty viable. Trust me that a lot of people have their eyes on that. I mean, this is promoted by members of Congress and senators, and the other side of promoting, tax the fat cat bankers is, money I can get my hands on and allocate. So there are many people who have laid claim to a pile of money that doesn't exist and may never exist. Nonetheless, the transactional relationship of evil to a common good is something that would seem to work. So the nexus, talking about that transaction day. Just one other thing. The other thing that's discussed is the wetlands mitigation. I see the nexus. There's a nexus argument to be made there. From a political standpoint, I'm not a politician. I hang around with some, but I would think that taking on another collateral issue and taking on an environmental issue interest might be something that even if this were to be viable, and I think it's less viable because it's less big than the insurance tax, I think that's something to from a political standpoint, to be cautionary about. But in terms of viability, each of these things work. It's a question of satisfying these urges to be transactional at this point. Thanks.
Thank you, Wallace. That's I like the idea of taxing money that doesn't really exist. But picking up from the idea of socializing costs, I'd like to turn it over to Marcel, who joins us, who's more recently from his group opened up in an American office. You guys, I believe, are based in Rotterdam. And one of the interesting components, and I think Dusan highlighted this on some level, is particularly specific within the Netherlands, but also within the EU in general, is a methodology, a cost-benefit methodology that looks at both in terms of outcomes and, as well as highlighted, our necessity to measure something, whether it's for risk underwriting or for financial underwriting or whatnot. Accountability in many ways is one advantage, perhaps. But in terms of the Dutch perspective on integrated cost-benefit analyses and that type of, and how that advances financing in terms of showing who's investing and who's really making the return, and thinking about that return very often in non-financial terms. Again, something Dusan had highlighted specifically with the labor component of it. How do you see that model in terms of your own advisory practice and domesticating that into the United States? How do you see that playing out given the highly sort of fractured jurisdictional federalist component of regulation and of, let's say, a highly legalistic component of how we handle many of these social issues? How does that translate?
Okay, thank you, Jesse. So let me start by saying that a diehard economist would say that a benefit cost analysis approach is the answer to all your questions about feasibility, and it sort of replaces any sort of decision making. Or I'm not a diehard economist, but I do think that a benefit cost analysis approach can make better projects and can improve decision making and can help finding funding and financing solutions. So that's all, and that's a lot. And I'll explain how we are doing that in the Netherlands and how we are trying to also apply that in the US. I'm currently involved in the Rebuild by Design competition as one of the bidders, and we're trying to use this approach. And so why I think it is a good approach to start with is for two reasons. One, it sort of takes off the focus on cost. So I know that in a lot of discussions on investments in resiliency, there's a lot of focus on cost and who's going to fund the project and how we can raise more money on the basis of taxes or whatever, mostly public sources. And I think it's better to start thinking about where the revenues can be. So it's both about social and financial revenues. But I think the benefit cost analysis forces you to not only think about the cost, but also think about potential revenues. And another advantage of the methodology of this approach is that it looks at projects in a more integrated way and not a standalone project. So the Dutch may be famous for these massive standalone dams and levees and that kind of stuff, but frankly, that is not typical for the Dutch approach. The Netherlands is a very small country, and everything, it is so dense that every intervention in terms of resiliency infrastructure, flood prevention infrastructure, is automatically integrated with other features. For example, energy or transport systems. And I will give you some examples of that later. But for example, we are working on a project in the Philippines currently, and that is a dam that is intended to be a flood prevention measure. But at the same time, we try to make this a hydropower dam as well, and also use it for water supply. So it's making smart combinations. So don't focus on the cost of the resiliency investment so much. Also look at where the revenues can be. Maybe I should elaborate a little bit on what, for me, the benefit cost analysis approach is. So from an economic perspective, it is all about identifying all financial and social and economic, so including environmental and employment and all effects. And economists say the word economic effects means that you're covering everything. So identifying all these effects, and if possible, value them, which then can result in a project's return, internal rate of return, or it can result in a net present value of all these costs and benefits. Of course, the challenge then still is to, because it can be a project can be attractive from an economic standing point, but then how to make money out of it is the next question. But the benefit cost analysis approach helps in doing that. How we are using that approach in some of the projects in the Netherlands is we try to structure, in the first place, we try to structure the discussion on projects. And that's basically so even if we wouldn't come up with one net present value that is going to tell you whether the project is attractive or not, it structures the discussion. It structures what the benefits are, what the costs are, what the package is that we're looking at. And that also means that it helps in optimizing a project, because if you don't know if you are not measuring anything, you don't know how to improve a project. So if you're not measuring environmental impact, if you're not measuring job creation, if you're not trying to combine it in a structured assessment, it is rather difficult to make a better project. So I think that the benefit cost analysis approach helps in making a better project. And then, of course, that can also help in convincing potential contributors to a project to invest. Can be stakeholders in a certain district, property owners, but also governments. So if a project leads to tremendous economic effects, job creation, that in itself can be a justification for government contribution. But it shouldn't be focused on government contribution only, I think. But I think the approach can help we were talking about accountability, and I think measuring these effects and sort of proving that one project is more attractive than another, or that investing in a specific project makes sense from an economic standpoint helps. So the next step then is to let me say one thing. Another way in which the approach can help is in prioritizing. I think one of the biggest problems in talking about resiliency is that there's an overwhelming amount of ideas of how to prevent ourselves from flooding. And so, for example, the city of Rotterdam had wanted to be a climate-proof city, and then started developing all kind of interventions, and they ended up having some 300 different interventions. Then we have a new problem because we don't know what to do, and I think that is one of the worst things that worst things that can happen. That you're sitting there, you have all these great ideas, but you don't know what to do because you don't know how to make decisions. You don't know how to prioritize. So that's why we developed for the city of Rotterdam a tool that is based on benefit cost analysis, and that helps them assessing all these different interventions, and also continuously update their strategy, because there is so much uncertainty. We don't exactly know how the climate is going to change. We don't exactly know what the impact of interventions are. So instead of saying we are going to make a decision for the next 50 years, they use this tool for dynamic decision making. So it's based on benefit cost analysis, and it helps them constantly in prioritizing what they're doing. Now, what's so special about the tool? The tool contains a lot of a whole database of typical interventions. It contains a database of what the expected effects or impacts are, and it can deal with uncertainty. And that's one of the most difficult things, I believe, in decision making on investment projects is the uncertainty. So how to deal with the uncertainty. So after the prioritizing, the question becomes, okay, now we know what kind of projects we want to do, but now how to get them implemented. And so the next step is, and we're doing that in practice, is starting discussions with stakeholders, how they can, having a sort of a common language on what the benefits and costs of the project are. We start talking about what each and every stakeholder can contribute to the project. And then come up with an institutional structure and financing arrangement, and I'm sure we are going to talk about that later. But one practical example of that is, for example, there's a business district in Rotterdam, and it was flooded some time ago, and to make it more flood-proof, there were sort of two solutions. One is that all property owners would individually improve their buildings, and the other solution would be to raise a key wall. And then, so now we're in a discussion with all these stakeholders to compare these two options, and we are also trying to make the key wall solution, which takes care of all the problems of the individual property owners. We are trying to combine it with other revenue sources. For example, in another place, we combined a key wall with a parking garage, which means that you can generate new revenues, and you can use the same infrastructure for other uses and to create additional revenues. So that is, in brief, how I see this working in the Netherlands, and I don't see why this can't work in the US. Yes, there are difficulties, but I think I would never be able to explain to a taxpayer why we wouldn't first optimize project and waste taxpayers' money just because we cannot organize it.
Yeah, thank you, Marcel. I think one of the things you highlight that is instructive for all of us is the degree of communication and how communicating, we speak in terms of climate and resiliency, yes, and communicating science is not always the easiest thing, and communicating economic science and urban science, if you will, is not always the easiest thing. Of course, there's always limitations to what science is. And one thing I'd highlight that is an interesting dialogue is actually the Dutch-Brazilian dialogue, because in Brazil, they have codified a philosophical notion of the right to the city as a legal mechanism, which has resulted in a variety of different things, including participatory budgeting, which we've now started to experiment with here in the town. And it's really fascinating because some of the Dutch have taken these sort of scenario planning tools, these tools that are really oriented at the management level, and translated them to provide a mechanism for people in Brazil in different levels of districts and jurisdictions to collaboratively understand the implications of different types of investments they're making with their own tax dollars. And I think I think that is a really interesting idea in terms of information. Talking transition, which is going on right now down on Canal Street, I think is another interesting proposition along those lines, to the extent that we have greater transparency in the information of how people prioritize things. Now, there's all kinds of problems of agency and representation, but I think it's a start, and I think it's a useful integration of technology and also a certain methodology. So taking it from one scale in terms of the international best practices, I'd like to turn it over to Chris here from Celtic Energy, and who's really a specialization in the energy component. We heard in the first panel the disproportionate impact that certain communities have had in terms of their energy consumption and pricing of that consumption. And if you look again, going back to the SIR report, one of the components that they had highlighted was essentially a rate case, right? We go back to the Public Service Commission, we ask the Public Service Commission to raise rates to capitalize, arguably, and this is a debatable point, certain capital interventions which perhaps should have already been undertaken that we should have already been paying for. So it's a two-part question. What do you think is the sort of optimal route for the PSC going forward in regulating these types of resiliency investments? And what are the opportunities that could come out of that from your perspective in terms of organizational models, and what can the energy firms do that actually has a meaningful impact on the bottom line of families and consumers?
Thank you, Jesse. Hi, everyone. Thanks for taking the time to be here. I work for a small company called Celtic Energy in Connecticut. Just to let you know what we do, since I'm kind of among these heavyweights, I'm an overweight, middleweight. Our small company mostly does owners' representation work for municipalities, federal facilities, school districts, and so on for third-party energy services like retrofits through energy savings performance contracting or power purchase agreements and a variety of other kind of energy and strategic planning. I've been an energy and sustainability person my whole career. We're based outside of Hartford, which, if you haven't heard of it, is the capital of your larger neighbor to the north, Connecticut. And so if you'll forgive me, I'm not so up to speed on the details of our smaller neighbor to the south here on the Public Service Commission and its rate case, but I can tell you what I think they should do, because that's what experts are supposed to do, right? The risk that a lot of people have raised in this and other rate-based investments in the name of resilience, and we're grappling with this in Connecticut in the wake of Sandy as well, is to avoid double counting and to avoid having the utilities intentionally or unintentionally allocate essentially ratepayer money that's been garnered in the name of electric service for purposes that aren't necessarily directly supporting the continuity of that service in the event of some kind of interruption. And I originally came into the energy field from the national security side, and I've been a firefighter and EMT for a long time. So my idea of resilience is kind of an all hazards approach. I don't really care so much why the power goes away or why your water doesn't work. I want to help design systems that make sure that those critical services continue. So from the point of view of using ratepayer money, I think for one thing, you can create criteria to screen investments that the utilities propose according to their public benefit. And I would suggest that distribution of those resources is not just equitable, but also more resilient in terms of focusing it both geographically and also on the energy infrastructure that supports the services that are most critical to the city and to the communities around it and to the state. And if you look at the impact of the recent power failure on transformer that was supporting the rail network here, that had a gigantic impact economically as well as from a resilience point of view. I know New Jersey is looking at doing a microgrid for its transport system now. Connecticut is as well. That making investments according to criteria of where they would support systems that have the greatest public benefit, such as public transit, such as water supply, and to protect vulnerable populations, such as public housing, and to support critical operations. Those are all kind of no-brainers, and it should not be difficult for the Public Service Commission, even if it needs to bring on new skills and create a new sort of resilience-oriented review board, to make sure that that money is focused in a way, perhaps by a scored process, which is often how municipalities evaluate competing proposals. In Connecticut, we have a microgrid program that the state has financed in the wake of the two storms in 2011, and that money is actually bond funded, not ratepayer money, although some of the incentives that can support microgrid development are based on ratepayer money, but that the projects, which are typically municipal but not entirely, submit to a scored grant application process, and the criteria are not just technical but public benefit and environmental impact and so on, and a similar process could be undertaken here, and that idea is not new. And I would also say that centralized networks are inherently more brittle and vulnerable than decentralized networks. And when it comes to energy systems, most of our outages originate in the grid. The United States is the only G8 country where the trend is to more frequent and longer duration outages, and that's a lot because of deferred investment. We spent a great deal of time and effort restructuring or deregulating our electricity industry and decoupling generation from grid management and so on. So now we have utilities that aren't selling us power but are rate-basing grid investments. And if you look to some of the more progressive experiments in incentivizing these utilities to get what you want for the public benefit, and I think California is a leading example. A lot of people don't realize this, but California has held its per capita electricity use flat for 40 years. And if the entire United States had done what they had done, we would meet the Kyoto Protocol targets. And obviously they have a nice lifestyle. They're not all living in yurts unless they want to up north. So, it can be done. And if you, I would consider that if we put the same kind of effort into incentivizing utilities by rewarding them for making investments that support greater resilience, that's kind of the way to go. I would also say that based more on what I do day to day, there's also a lot of money to be dedicated for retrofits, which I think is really where the battle is going to be won or lost on getting ready for climate, because something like 80% of the building stock that will exist in 2030, if not 2050, is standing already. And if we can't figure out how to fix that, and there are a lot of ways to fix it, then we're not going to be able to get the kind of carbon and energy reductions we want to see. And in addition, those facilities connected to the grid or not are really where the services that we depend on are delivered. And so perhaps we can address that a little later on.
Great. Thanks, Chris. That's really an amazing statistic specific to California and the Kyoto Protocol. I'll turn this over to Chuck, and we'll go here for a quicker round of questions before opening it up to Q&A in a short while. Given, let's say, the prevalence towards, perhaps reliance on, and this is a bit of a neoliberal slippery slope, in favor of the third sector, right? The idea that government stops providing these critical social services and addressing the needs of critical populations in favor of pushing those obligations back onto foundations, not-for-profits. This has had debatable, again, variable impacts in different economies and societies since the dawn of this thinking. But at the same time, there are a number of institutes, foundations, and whatnot that are playing a significant role in taking a leadership position in both the thought development, but also taking some financial risk in promoting that. And that's certainly a laudable ambition for many of these groups. So in your opinion, where do you see, particularly philanthropic organizations, institutions, foundations, and whatnot, what do you see their role being in advancing the financing and or economic feasibility of some of these interventions that we speak of?
Yeah, and there's a reasonably good history of foundations using their money to beat government up and incentivize government into doing things that it wouldn't otherwise do. That's, the use of foundation money to partner with government and to create first loss positions that are shared with government in order to, in turn, with foundation and public capital, leverage private capital, is something in the affordable housing sector we've done for 30 years in New York City. And there's no reason that a lot of those models can't be used in financing mitigation and resiliency and climate change activities. I think the challenge there is not the governmental money, is not the foundation money, but figuring out how the governmental money can come in and how to broaden the tax base and find taxing districts, taxes that in fact can be levied politically, that are wide enough, broad enough, deep enough in order to create pools of money that are big. And so there's a lot of room for foundation money, and there's some technical challenges. Commenting on the technical challenges, some foundations have taken a pretty narrow view of charitable purposes, and climate change and environmental activities within the 501c3 safe harbors for what's an activity that's eligible. There's some differences of opinion amongst lawyers. There's some foundations that are very progressive and forward point of view, as to what's eligible and what can be done with philanthropic money, where the benefit is very, very broad and not targeted to very low-income people. In the climate change area, others have a more conservative view. So that, that's just a technical IRS issue. But as a construct, we have a lot of history in doing this, especially in New York.
Thanks, Chuck. I'd turn it over here to Richard. By my count, just in adaptation, not in mitigation, there's roughly $50 billion of capital sitting in a variety of funds globally. And so many of these are Southeast Asia, Africa, Latin America. Surprisingly, I could not count any more than several $billion allocated to funds with a target market really in North America. And so from your expertise in private financing now in your current capacity, what are the strategy and mechanics of aligning the returns that funds need to have and the timing mechanisms of the return of those funds, which are short and midterm very often, with the necessity and very often for investing in interventions which really cover a very long spectrum? What is that strategy going forward, not just for climate, but for a larger social investment that funds may be undertaking?
I don't know if one exists. I mean, if you think about it, $50 billion on a global scale isn't really a lot of money. And so I think the reason for that is for exactly the dilemma in the question that you pose, which is that I think it's very hard. Fund managers have bosses, and those bosses are their investors, and a lot of it comes down to the investment objectives of the capital sources that are focused on this. And I think that for the most part, they kind of fall into two separate camps. You have investment capital and money that is patient, is looking at a broader objective. Contrary to popular opinion, that's typically not a pension fund, because while the pensioners or the beneficiaries are in the fund for a long time, typically the objectives of those fund managers are much shorter term in their duration. And so I think identifying folks who have capital, maybe in the philanthropic space, where potentially you could get foundations and philanthropy to align the investment objectives of their endowments with their objectives on the grant-making side. To my knowledge, there are only a handful of foundations that are actually willing to do that, where the objective of the corpus of the money that they manage is aligned with the grant-making philosophy. If you were to get investors who had a longer-term view, you could potentially then recruit fund managers who had took a longer-term view. As a general matter, in the funds that I've been involved in the discrete fund that I specifically managed on behalf of Goldman Sachs, in this regard, we were not managing client money. We were managing firm money, and we were specifically focused on a longer-term objectives, more patient capital, in large part because the firm had broader objectives that it wanted to accomplish, which were not just about making, just about the profit motive. And so people want to talk about double bottom line, triple bottom line, quadruple bottom line. One of the bottom lines that often is not mentioned is that in that context, right, there is a sacrifice that's made with at least to one of those bottom lines. And so I think people have to be honest and forthright about that the profit motive is not the primary motive. There are compromises made in that context. And I think that's an important objective. So that, however, is not necessarily, I don't think necessarily that sustainability, resiliency, those types of efforts are necessarily on their own relegated to that type of investment strategy. I think, as Chuck mentions, I think in the context of affordable housing and a variety of other initiatives that I'm familiar with, you can make money. You can be very focused on a profit bottom line and accomplish some of the objectives that are necessary in order to support advancing appropriate and I think laudable, social objectives.
Great, thanks a lot. And it's great here today to see a number of representatives from City Hall, from FEMA, from HUD, and it's great to have you guys here. But part of your obligation to the city is one of transparency, or at least it's one which we impose upon you. Turning to James, given in the first panel, it certainly came up, the transparency component of post 9/11 experience was I think questionable depending on who you ask. And for all the right reasons, I would assume, but I think information in that regard, I think is in some ways a theme today, is important. And where do you see the proper mechanisms for transparency going forward, particularly with the community development block grant money coming into the city?
Well, New York City is a big city, and we have various institutions that could be utilized in a way to foster the sort of community-based input that I think everybody recognizes is absolutely essential and would be good to see in this area. I guess what I always see as an underutilized structure is community boards. New York City has 59, 60 sort of, fairly definable neighborhoods, community boards to a good extent sort of overlap with these definable neighborhoods. These could be mechanisms for broadening participation, not only in response to Sandy and talking about how to utilize community development block grants to address the various needs that residents, that local businesses, that larger businesses, that important parts of the city face. But maybe these should be used in a broader sense for discussions on a broader range of issues relating to the city budget, certainly the capital budget. We've seen in the last couple of years a very interesting experiment with participatory budgeting in a handful of council districts. My sense is that has engaged a lot of people and given people a sense of involvement and consultation on those things. In the end, it's not clear that the uses to which those capital funds were put were a lot different from what would have happened before, because council people do, whether they like it or not, have to hear from a lot of constituents on things. So they sort of do get that sort of sense, in the pre-existing manner in which they received input. But I think it's a starting point, and I think the city needs to do more of that. The talking transition undertaking is, also has potential. That's a considerable investment for a short-lived undertaking. I was part of a panel on the city budget on Saturday morning, which, while it rained early on, turned out to be a beautiful day. And like this panel, we had a lot of great, very well-informed experts on it. But there were almost more people on the stage than there were in the audience for something like that. So it takes time and effort and innovative ways to solicit community input. But I think one of the lessons of the recent election in New York City is that people feel like they should be consulted on things, and I think, there was also considerable new blood being elected to the city council, and I think one of the things that they're going to be, one of the things that they should be looking at, and they probably are thinking about how to do that, is how to broaden the level of community input on the sort of decisions that the council and city hall normally take up, including over things like community development block grants.
Wallace, I'll turn to you on this one. Assuming Bill Ackerman doesn't get his way and somehow the GSEs, Fannie Mae in particular, still has a significant public component to it. And also given the history of some of the changes in biasing of certain financing mechanisms within HUD and Fannie Mae and Freddie Mac for promoting, let's say, transportation-oriented development and a number of laudable considerations along those lines. Is there an opportunity? I mean, at the end of the day, when we speak of resiliency, we also speak in the Flood Insurance Reform Act last year in terms of bringing forward the true risk. And a lot of times what we speak of in that context, and what we speak of are people who are really living in high-risk areas. And these people do not have the ability to necessarily finance the improvements that they need. So over the long term, is there a role in the federal government towards imposing risk, biasing financing in some way in these high-risk areas, or do we create a scenario where we redline via environmental conditions in a way that exacerbates the underlying equity by and between residents and their own risk consumption?
Well, the answer really is, of course, areas that are in greater risk will involve, if what you're doing is doing some sort of a calculation, spreadsheet calculation, to determine what the cost of putting money into a particular place or activity, and if that has additional risks, then redlining is essentially what's going to happen in the sense that people will evaluate those risks. If it's an accurate measure, at least that's something you know, very likely it's an inaccurate measure because we have gotten lousy at measuring things. Actually, no, we've gotten better at measuring things, but we've gotten lousy at thinking we're measuring things that we're not. And just a slight digression. The concept that was mentioned, pension funds are short-term investors. I just reflect on how wacky that is. Pension funds are the most long-lived activities in the galaxy. And indeed, they measure their performance by short-term, largely by short-term activity. And the reason they do it is because you can measure it. And if you can measure it and say you've got the right number, then you can charge based on that, on accomplishing something in relation to that standard. So we've gotten to the place where our models are the reason. we actually make decisions based on what we can model. And economists you should check out some of, there's an Insitute for New Economic Thinking did a whole series of conferences on just that issue at King's College. Check it out because it's got some great stuff. Back to the point. Yeah, sure. That kind of risk allocation, if you will, to some either overt or obscure path into a social entity, the federal government, the city, the state, whomever, even nonprofits to some extent. That kind of allocation is a way to mitigate and peel off, if you will, the potential risk of redlining or impediments to actually developing in more risky areas. By making that decision, we're saying we're not going to let pure arithmetic, we call it market forces, decide that. we're going to decide that ourselves. And the fact is that would involve a cost-benefit analysis. It might be analytical, it might be just Congress or the state legislature or city council evaluating costs and benefits and deciding to do that. So certainly that's a possibility. I think that the politics of that are very hard, of course, right now. And to the extent that that actually is a way out, it'll be at least benefited by arguments that are associated with economic value as opposed to simply wanting to do good works for people. So that's my thought, and of course it's absolutely doable mechanically, politically. It's a difficult issue.
Thanks, Wallace. Picking up on the idea that perhaps, or the subtext that perhaps there's too many economists and too many economic professionals out there clouding the sphere of action. And I'll turn it over here to Marcel. In that regard, can you give us some best practice, some innovation that you think in the services side has contributed to meaningful change?
Yeah, okay. So I think if we focus on innovative financing and P3s, I think one step before that, before innovative financing, is innovative funding, because, and I think it's far more inspiring to first look into that, because ultimately somebody has to pay for it. So it's interesting to come up with all kind of financing solutions, but the funding is eventually even more important. So that's why. And we already talked about how to look into funding, innovative funding sources. It can be combining resiliency interventions with revenue generating functions, as we talked about before, or it can be how to incentivize other stakeholders than just the government to invest in projects. But it's also about taxes. It can be, so we talked about property taxes, and I know, for example, that there is Prince George's County is considering levying a stormwater tax. So there can be different tax solutions, which then can be combined with innovative financing, like tax increment financing, and I think that can work. I think what's also interesting to look into is P3 solutions from other sectors, like transport infrastructure or urban development projects. I distinguish between P3s that are like a joint venture company of public and private companies, and P3s that are more like a very innovative contract in which the government transfers a lot of risk and responsibility to the market. So if we look at the first component, the first model, which is the joint venture of public and private parties, I think if you look at very complex and district-oriented projects with a lot of uncertainties, I don't think it makes any sense to go for a joint venture approach, because there are way too many uncertainties, and so no single stakeholder can commit to making whatever, commit for the next 40 years to do a lot of investments or to agree with any decision being made in that structure. So that is going to lead to a lot of governance issues. So I don't think that works. I do think the joint venture type solution can work for coordination. So if you feel, so there are different stakeholders in the district, and you want to develop joint integrated plans. So and of course, developing these plans takes time and cost, and so that can be a solution to do that in a joint venture. I don't think the joint venture as such is a solution to the magic solution to dealing with complicated and uncertain issues like the issues we're talking about. If we talk about the other type of P3s, like we know, for example, toll concessions, or also available. So there is a lot of familiarity with toll concessions. The operator is responsible for for building and maintaining and operating a road, for example, but it can also be a transit system for 50 years, and in return has the right to collect revenues. That is one P3 model. But if there are no revenues, then there is another, there are no revenues from the marketplace. There is another solution. It's called the availability payment P3 structure. It's being applied in social infrastructure, road infrastructure, transit, and it's basically a long-term performance contract. It is a performance contract. The government enters into doesn't. So the payment mechanism is that the government doesn't pay upon completion of a project, but pays a sort of a performance-based service fee over the next, 40 years. Only if the system, the transit system or the road or whatever, meets the requirements and functions, the operator gets paid. If not, then not. So that's a major incentive to come up with solutions that are smart, that are functioning for a long period of time. And that's also a model which incentivizes optimizing lifecycle costing. So this is being applied in these other sectors, and I think in some of the investments we're talking about. For example, again, Prince George's County is considering doing such a P3 model for a stormwater retention network. Those models can work. And so it doesn't only lead to better projects, because the idea is that the government incentivizes the market to come up with better solutions and to perform over a long period of time, but it also spreads the budgetary burden, which is a nice advantage as well. So I think that can work. One last point, please. Is I think there is also a lot we can do with innovative tender procedures, like the competition that is being run by HUD, really incentivizing and encouraging the industry, urban planners, construction companies, developers, to come up with smart solutions, better solutions. One example in the Netherlands is this big dike project. It needed to be renovated or reinvested in the to serve as a flood prevention measure. And the question was, okay, industry, can you please come up with solutions that are not just we could detail out a design and say, okay, this is what you have to build. But instead of that, so this is the issue. We want to at least have this, but how can you combine this with other smart solutions, energy projection, recreational facilities, whatever, to make it a more profitable business case? So that's another way of really using competition to come up with better solutions.
Yeah, so picking up on Rebuild by Design, one of the interesting things that have come out of it is at the district scale, a number of teams have taken on both financing, insurance, really interventions at the district and passing on, we speak in terms of TIF financing and whatnot. And this will be my final question, because I can hear the rocking in the seats before we get to Q&A very quickly. But Chris, from your point of view, where do we end up with district scale interventions, specifically at the energy? And you spoke briefly in terms of the distributive grid phenomenon. Where are we with that, and where can we go?
Yeah, this is kind of an exciting area now. Last week I was at the Eco Districts Conference, as were some other people in the audience, and this is an approach, and there are various funding mechanisms for it by which infrastructure can be jointly developed with sustainability and resilience objectives. With energy systems in particular, it's, I guess I'd say from a resilience point of view, ultimately there's nothing like an energy positive or a net zero energy building to support resilience. And if you can't do that, then district energy systems allow you many benefits so that you can deliver electricity, heat, cooling from the heat, for space heating or process or whatever. And these investments, combined heat and power in particular, often only make sense where you have a good heat sink and kind of doing it at scale. There are very exciting applications in Sweden and elsewhere where material flows are integrated into essentially turning waste into energy at the local scale and going for multiple streams of value, kind of the industrial ecology approach that was brought up earlier. But it's not the answer to everything. If you want some interesting examples, the Lloyd Eco District in Portland, Oregon, which is one of many, Lloyd's approach took a part of the town that had some large businesses and large landowners. They all chipped in, I think it was $25,000 a year to fund a small staff to help move forward a planning process and shared investments, some undertaken by property owners, some undertaken collectively, including a district energy system. There are other approaches like this being taken. I'll put my fire helmet on for a second and say, you know, the opportunity for integration here is fantastic, and one of the district energy systems in Toronto is leveraging an existing fire water loop that's placed in the city underground in the event of a seismic event, because if your pumping doesn't work, you can't fight fire, and they're tapping into that as a thermal sink. I wonder why not, you know, potable water, stormwater control. You want to look for investments where you get as many benefits as possible, and the integrative approach is really the approach to that. And the district scale allows you to leverage that and leverage things like business innovation districts or energy investment districts, which are designed as associations of private entities, but often say chartered by municipal leadership, where they can leverage both public and private investment and do so in different ways. And it's good that that's a fuzzy space, because fuzzy means there's room to innovate. I also, just to run on this for one moment on the innovation, I mentioned earlier retrofits, and there's a great big pie of money out there that we can all tap into to retrofit our infrastructure, and that is the locked-in waste that we are already committed to paying in buying energy to service inefficient buildings. You know, buildings, there's a joke about a camel as a horse designed by committee, no offense to camels, but all our buildings are camels. They're designed in very inefficient ways and disintegrated ways, and that's why there's a $5 billion a year, you know, retrofit industry, because they're not made right in the first place. People make short-term decisions, and so you can use for example, energy savings performance contracting, which our company works with a lot, to bring in a third-party energy services company that will use third-party investment to make detailed assessments of a collection of public infrastructure, typically, or institutional infrastructure. Private sector doesn't do so many of these because they have more capital. But if you're a university, municipality, federal facility, hospital, or something, you can, public housing, they audit your buildings in a very detailed manner. They make the improvements, new lights, fans, motors, whatever it is, pumping. Can be deeper energy retrofits if you can. And bundling all these measures together, the really quick payback, sexy stuff like lighting, with the deeper energy retrofit, longer payback things that also really allow you to reach greater carbon reductions, greater emissions reductions, and even installing things like on-site power, are then, because those measures lower your utility bills, that generates cash flow that is used to repay the financing for the project. So the city gets capital improvements at no capital outlay up front today, financed by tomorrow's energy savings, and there is a profit margin for the third party, but that's appropriate, and the savings are guaranteed. And if you look at the example that the investor confidence project that's put together by Environmental Defense Fund is following, with an eye toward the capital markets, one of the things that's holding back retrofit financing is that these audits and assessments of what the savings are going to be are not conducted in a consistent basis. And so ICP is trying to use, like LEED did, accepted best practices in building energy performance assessment, how the audits are conducted, ASHRAE 1, 2, level, and 3, the criteria, international measurement verification protocol, and it's thought that if we use these standard practices, then the capital markets, which for the most part are sitting on the sidelines of mass retrofits, will be able to say, okay, now when we look at a portfolio of these investments that maybe we want to bundle and resell into the capital markets like mortgages, we're more confident that we're comparing apples to apples because the valuation basis is consistent. And that's just beginning. So standardized practices like that, you know, we can essentially leverage the future fat and mine it that we're already locked into, and through that make our facilities not just do climate change mitigation and adaptation with the same investments, because you're using less energy to do what you want to do. You can use it more greenly, but you can also fund other resilience enhancements. There are other tools that you can apply, and I'm happy to talk to folks about it offline.
So I think in the interest of time, but I just want to highlight one point, and I think that's something that unites us all here today, is this notion of ethics. And then there is a notion of ethics in the built environment. The work, particularly Warwick Fox, who revolutionized the field in thinking of it. There's the sociology of finance working groups, one led out of the University of Oxford, or Oxford University rather, that is really undertaking a lot of practical framework development and how the long-term nature of our problems have an ethical implication in terms of day-to-day decisions we make about investments and the protocol for how we evaluate and assess those investments. So I think with that, in the interest of time, we'd like to open it up to questions.
Use this mic.
Please.
I have a question regarding, you're talking about cost benefits. I'm beginning to think there's been a corruption of both costs and benefits. An example would be with the Port Ambrose for $600 million. They want to build this LNG plant that will only work for 30 days a year. And yet, using fossil fuels is what is presenting our climate problems. Could you address possibly your take on the corruption of defining costs and the corruption of defining benefits, because there are externality costs, there are benefits in intangibles and clean air, cuts down, health costs. So
Right. I think
maybe
Marcel,
you could comment on that.
if you could, Marcel.
Yeah, I'm not familiar with the example. I do know that across the world there is a lot of debate on to what extent you really want to value all the different costs and benefits, because it's being used as sort of a actually benefit cost analysis is also being used to just justify your own decisions. So you first make the decisions and then you justify it by doing a benefit cost analysis, and then it's really a manipulating tool. So I think if that is the case, I don't know how to so I'm not going to solve that, but I do think that that in itself is not a reason to not do any structured analyses anymore. Yeah, so.
Great, thanks.
Hi, my name is Rob Krateroof. I'm a planning practitioner here in New York. And in the first panel, Maya really spoke about the lack of access to capital for low-income communities and communities of color around development. And in this panel, there were a lot of examples around the abundance or potential abundance of capital. Many of those, however, are at the city scale, let it be if there's more free market development in certain places, or exactions for flood proofing or flood improvement. While community board planning, there is a history of that, 197A planning, a lot of that has been advisory in nature. How can there be teeth put in the programs and financial and otherwise that can help to make sure that as these programs are getting set up, that resources are allocated equitably?
James?
Yeah, thank you. Excellent question. There arguably should be some budget commitment to allow community boards and local 197A planning processes to be better supported. And there probably also needs to be a commitment to have the outcomes of that process be taken more seriously. So again, in theory, it's a great place to look to for the kind of grassroots input that you'd like to see. But in practice, the city can make lots of improvements if it supports that form of input in a more systematic way and figures out how to get those decisions taken seriously when time comes to make the big investments.
And I think I've been prompted in the interest of time to have several of the questions asked, and then we'll proceed to the answers thereafter.
When dealing with the built environment, I'm sorry, my name's Scott Grimlyon. I'm a planner here in the city. When dealing with the built environment, one of the biggest issues is displacement of local communities. And aside from the sort of promise of jobs that local communities may not be necessarily ready to accept when development happens in the area, what types of financial mechanisms could be built so that actual dividends are being paid to local residents before these absentee investors come in?
Great, thanks.
Hi, my name is Christina. I'm with Citizen Action. I'm an organizer, and I have lots of conversations with residents of public housing, and I understand that there's already some privatization and public-private partnerships underway. And from my conversations, this has been absolutely disastrous for the residents of public housing from their point of view. I also feel that it goes significantly against the ideological need to reclaim the sense of public and reclaim the sense of common good that we need to secure the sort of meaningful investment in these sort of projects, both financial and social.
Hi, my name is Felice Segura, and I'm with the Laborers. But this question is sort of more from my background as an environmental attorney. The question is kind of broad, but it's based on the notion of the legal and regulatory framework, the idea of how we're valuing these goods for the public and for people who are making money. So you start with your 70s command and control model, and that works for a lot of things. And then you get this pushback. We need market-based ideas. We need market incentives. We need climate credit exchange. And everything that comes into place, there's a private actor with a lot of money who pushes back. And they either push back against the regulation or they push back against the market-based incentive, even sometimes in the same project. And that's what's hard for me as someone who has to consume a lot of news about these issues, is I can look at a project from its history to its end and see the promises that were made that weren't kept. A good example would be water taxis. I think other examples would be affordable housing. And it sort of shows how these market-based incentives aren't necessarily working. They're often, because of corruption or because of the focus on the bottom line, sort of just a way to push money around between certain individuals who aren't the people living in the housing. And at the same time, with the economic valuation, the people living in the housing, Katrina would be a good example. You know, if you lose all your personal property but you don't own any real property, you have lost less than the person who lost 2 out of 3 of their homes. But what is the value of that loss to you? New York City, what is the value of having to carry water upstairs to your apartment every day when you work 1 or 2 jobs or maybe are looking for work? So, I mean, this sounds like a little bit of a rant on the side of the poor, but my question is, like, nobody wants to pay for the upfront investment even if they know there'll be savings. Nobody wants the regulation, even when regulation will make the market more stable and actually save them money. And the people who can't afford the instability are experiencing the most instability. So what is the structure? I'm not concluding, but what is the structure? I mean, in terms of Holland, this is why we can't pay for these things. So what would be the structure that would pay for equitable development and for enforcement to make sure that it goes forward as promised?
Yeah, I think alternative notions of value are something we can take up real briefly in the end. And I'm sorry, one final question.
Hi, my name is Roger van Vlissingen. I consult in the area of the economics of renewable energy retrofits. And I just wonder a lot of the time why we're not doing more and why there isn't more public dialogue about simply restructuring various programs and incentives and stuff at all levels, city, federal, state, local, what have you, that seem to be doing the opposite of what we claim to want to do, which, latest I understand, is reducing greenhouse gas emissions. And for my money, one of the big examples is the New York City Clean Heat Program, which basically has been a subsidy to the gas companies, and half of the housing stock that's being converted to natural gas under the auspices of that program would actually probably have better long-term economics if they converted to substantial renewable energy conversions. And I just wonder why the dialogue isn't happening I'm doing all I can to get it going.
Thank you, thank you. Specific to the first question, I'll take that in terms of distilling it to the proposition of why many of these entities don't pay dividends. And I had something that I advanced called the Community Growth REIT, which actually added geographical restrictions on shareholders to allow people within, at the scale of certain communities, really to invest in those communities in terms of the territorialization of capital, but also to benefit from those dividends and not have those dividends paid out in a, let's say, a structured global financial world. And so in many ways, having advanced that, and a number of institutions advanced the idea, ultimately at the end of the day, it came down to securities regulations and the idea of notions of simple things like accredited investors, and that in many ways the government, by virtue of a lot of things I think that were well intended at the time and perhaps still are in terms of the financial sophistication of individuals to make these types of investments. At the end of the day, the regulations are a real barrier, or at least in terms of thinking innovatively about how communities can really pay back dividends. Specific to the question about how you value the good and what are the alternative notions of value good, perhaps Marcel, you could speak to that if briefly on, I think you spoke as to the monetized and non-monetized realm, but what are these notions of the alternative good specific to specific financing vehicles? I mean, I think you picked on it a little bit with social impact bonds, but is that really, at the end of the day, that also requires a government guarantee, or at least in practice, that's the way it has been undertaken and structured.
Yeah, I think across the world I see two different motives for doing P3s or innovative finance solutions. One is we want to get the projects done. The second one is we want to create better deals leading to a better deal for society. And so if you're focused on the first motive, if your point is we want to do projects, we don't have the money, let's do P3s, let's let the private sector just invest in a project and don't pay a lot of attention to proper incentives to get what we wanted, then you will end up having a different P3 deal, a different arrangement between public and private than if you start from the very beginning at looking how we can create a better allocation of risk between public and private, how we can make a better allocation of responsibilities, how we can provide incentives that align public and private interests. And I think that I have seen examples in the US in which it's very much the first motive that led to creating P3s, not the second. And I think that explains what, I think there are some crappy deals, and that is just because the primary motive is let's get in the private money. But that's a wrong, or okay, this is very subjective, but I think it's wrong.
Well, thank you very much to all our panelists for joining us today. Is any concluding remarks that the panelists would like to make?
Please, I would like to remark on the fact that the answers to many of the questions that were asked were in the questions. If you ask the question, where's the source of capital? What you're asking is really, because there's abundant capital, there's a shortage of political will. If you ask the question, where's the source of capital, that throws you into the range of measuring the returns on these things by private kinds of calculations. The government is supposed to be doing things that are in the collective good, not the kinds of things that companies are doing. The public-private partnerships that have happened have had tremendous problems and tremendous outcome problems, including the whole issue of the transmission grid is all about privatization of generation, which I, by the way, pushed and convinced a whole lot of people to do at one point in my career. So, so please keep in mind, the real issue here isn't about sources of capital. There's sources of capital, and people will come up with ways to get it. The real issue is about political will. Thanks.
Excellent. I think that's great concluding remarks. Thank you.